What happens when your bank suddenly locks you out of your own money? When the ATM stops working, when wire transfers are delayed, when your online banking mysteriously crashes, will you be ready? Because the reality is, five major banks are on the verge of total collapse. And no, this isn't fear-mongering. This is hard data, global economic trends, and insider warnings all pointing to a financial disaster in 2025 that will make 2008 look like a minor inconvenience. You've seen the cracks forming, massive layoffs, liquidity crunches, collapsing commercial real estate, and banks quietly stockpiling bonds instead of lending. That's not normal. That's a sign they know something big is coming, and they're bracing for impact while keeping you in the dark. And when the dominoes start falling, it won't be a slow-motion train wreck. It'll be an all-out liquidity panic. The Fed won't save you, deposit insurance won't cover the losses, and the financial elites will move their wealth long before you even realize what's happening. That's why you need to know which banks are about to go under so you can move your money before it's too late. I'll break down the five banks that will collapse in 2025, why their balance sheets are crumbling, and how the financial system is being rigged against everyday depositors. Stay until the end because I'm also going to tell you where the smart money is moving right now and how you can protect yourself before it's too late. Disclaimer: this content is for informational and educational purposes only and should not be taken as financial advice. We are not financial advisors, and you should always do your own research before making any investment or banking decisions. Past performance is not indicative of future results, and all investments carry risk. Consult with a qualified professional before making financial decisions. Done with the disclaimer, now let's get into it. Number 5. Barclays. Barclays is teetering on the edge of a catastrophic plunge that analysts say could erupt into a full-blown crisis by 2025, and if you're wondering just how serious this might be, you've come to the right place. We're talking about a bank with roots stretching back over 3 centuries, a massive balance sheet that's heavily exposed to European markets, and an ever-increasing reliance on complex derivative instruments. Now, it might surprise you to learn that over the last 2 years, Barclays has seen a steady rise in its non-performing loans ratio, which sits uncomfortably above its post-2008 average, an ominous sign of mounting defaults that could send shockwaves throughout the global financial system. Remember that Europe itself has been grappling with weakening economic growth, stubbornly high inflation, and a precariously shifting monetary policy environment. A bank like Barclays, deeply entrenched in bond trading, corporate financing, and consumer credit, is uniquely vulnerable to a perfect storm of systemic stress. But the real problem here goes beyond just its exposure to shaky markets. Barclays has been quietly piling up exposure in commercial real estate loans across the UK and parts of the Eurozone, areas that have been slammed by higher interest rates and falling occupancy rates. Analysts warn that if central banks keep tightening liquidity, and let's face it, central banks claim they can keep everything under control but rarely see a crisis coming, Barclays could be stuck holding billions in devalued assets. Worse yet, when liquidity dries up, it's often the derivatives markets that get hit first, meaning Barclays' massive positions in interest rate swaps and currency hedges could come under severe pressure. This is how a bank that looks strong on paper can suddenly face a fire sale of assets just to meet margin calls. We also can't ignore that the shift in consumer spending has hammered retail banking revenue. Across Europe, families are struggling with rising living costs, and that means fewer people taking on mortgages, fewer auto loans, and a spiking default rate on credit cards. Barclays has been propping up profits in recent quarters through cost-cutting measures, but at some point there's only so much fat to trim before the underlying weaknesses become undeniable. Add in some very public compliance missteps in recent years, and you've got a recipe for eroded trust and potential capital flight if panic sets in. Let's not forget that once trust goes, depositors can flee at lightning speed. And that's precisely the kind of scenario that can spark a global liquidity crunch, something that keeps bankers and regulators alike up at night. Barclays might look stable enough from the outside, but the cracks are forming, And if 2025 brings the kind of global economic slowdown some forecasters are bracing for, Barclays could be in for a sudden and dramatic tumble unlike anything we've seen since 2008. Number 4. HSBC. HSBC is another heavyweight bank many of you might assume is too big to fail, yet insiders are whispering that this global juggernaut could be on track for a colossal unraveling in 2025. Why? Look no further than its extensive footprint across Asia, Europe, and the Americas, which in normal times is a strength, but in a period of synchronized economic downturn could turn into an epic liability. Don't just take my word for it. Recent data from the Hong Kong Monetary Authority suggests that large cross-border flows have become notoriously volatile, potentially jeopardizing HSBC's broad base of operations. The bank is neck-deep in emerging markets where corporate debt levels have ballooned to record highs and local governments are struggling to contain inflationary pressures. Compounding matters is HSBC's complicated relationship with China, especially as Beijing's stop-and-go economic policies have spooked investors and triggered capital flight. Each time the People's Bank of China injects liquidity, it seems to vanish as quickly as it arrives, hinting that major players, often including big foreign-linked banks like HSBC, are funneling cash into safer havens. And it's not just about the Chinese market. HSBC has historically relied on robust trade flows to fuel its transactional and fee-based income. But with ongoing geopolitical tensions, including new tariffs and trade barriers, those once reliable revenue streams might begin to dry up. When a bank that large sees multiple streams start to choke, it can trigger a liquidity shortfall that prompts credit lines to be frozen, which in turn leads to a vicious circle of declining confidence. Adding even more pressure is the fact that HSBC's massive global workforce creates a cost structure that's slow to adapt to sudden shifts in economic conditions. The bank has tried to pivot to digital platforms, but layoffs and restructuring can only go so far if entire regions face economic downturns simultaneously. According to internal memos leaked to the press, though HSBC denies their significance, management has been scrambling to shore up capital reserves well in advance of any major crisis. Yet questions remain about whether that capital would be sufficient in a scenario where defaults in emerging markets spike, real estate values in the UK tumble further, and consumer credit in the US keeps deteriorating. Now, the real kicker is that when big banks start to hoard treasuries instead of lending, it's a telltale sign that management is bracing for a liquidity crunch. Reports show HSBC's holdings of government debt have soared in recent quarters, mirroring the behavior of other banks on this list. They're preparing for the worst, even if they won't admit it publicly. And as we edge closer to 2025, the question becomes, will HSBC's global sprawl protect it by offering diversified revenue streams, or will it magnify every localized crisis into a bank-wide meltdown? If a crisis hits them hard enough, it won't just be a problem for Asia or Europe, it will be a worldwide liquidity shock, with HSBC at the very center of it all. Number 3. Wells Fargo. Wells Fargo, long a staple of American banking and once considered a pillar of stability, has faced a string of scandals and missteps that have chipped away at its reputation. The big question as we look toward 2025 is whether these mounting challenges will prove too heavy a burden for the bank to carry. If you've been following the news, you already know that Wells Fargo has battled fallout from fraudulent account openings, consumer distrust, and regulatory fines that have burned massive holes in its bottom line. Even though the bank has tried to rectify its corporate culture and operational processes, the lingering effects of those controversies could morph into a full-blown credibility crisis if the economic environment deteriorates. One of the more pressing concerns is how Wells Fargo's loan portfolio might hold up if the U.S. slips into a deeper slowdown. Recent data from the Federal Reserve shows that commercial banks, including Wells Fargo, have already tightened lending standards across multiple categories, from home mortgages to small business loans. Tighter lending standards can slow economic growth further because fewer consumers and businesses can qualify for credit. And in a debt-fueled economy, a restriction on borrowing can cascade quickly, leading to reduced consumer spending and ultimately an acceleration of layoffs. Wells Fargo would be caught in the middle. On one hand, it needs to protect itself from defaults. On the other, if it stops lending, it contributes to the very economic downturn that heightens its own risk. Meanwhile, deposit outflows are another silent threat lurking in the background. According to a recent quarterly report, customer deposits at Wells Fargo have been gradually declining as the bank grappled with public relations nightmares. Some depositors have migrated to smaller community banks they perceive as more trustworthy or to big competitors that have sidestepped scandal. If deposit flight worsens during an economic downturn, an event often triggered by a spike in unemployment and rising default rates, Wells Fargo could find itself in a precarious scramble for liquidity. And if we see a repeat of March 2023, when sudden panic led the Fed to inject large sums into the financial system, there's no telling how quickly depositors could withdraw their funds and accelerate a crisis. Moreover, Wells Fargo's exposure to the commercial real estate sector in the U.S. should not be underestimated. Office spaces remain underutilized, and many property owners are dangerously close to default if occupancy rates don't recover or if interest rates remain high. Wells Fargo's balance sheet could take a severe hit if a wave of commercial real estate loans turns sour. As 2025 approaches, the bank's precarious dance between managing risk and fueling growth becomes ever more difficult, setting the stage for a possible meltdown if broader macro forces tip in the wrong direction. Number 2. Deutsche Bank. Deutsche Bank's precarious position has been the subject of market rumors and sensational headlines for years, and those warnings might culminate in a full-scale collapse by 2025 if the global economic landscape continues to darken. We're not just talking about minor hiccups here, we're talking about an institution that has weathered repeated restructurings, cost-cutting initiatives, and regulatory scrutiny, yet still finds itself saddled with hefty risks lurking beneath its massive derivatives portfolio. While the European Central Bank insists the region's financial system is resilient, it's an open secret that Deutsche Bank's tangled web of interest rate swaps, credit default swaps, and other complex instruments puts it at the epicenter of any potential European meltdown. Consider, too, the broader European economy, which has been showing signs of stagnation at a time when inflation is hitting multi-decade highs. Central banks are caught between the need to quell inflation with rate hikes and the risk of driving fragile economies into recession. This balancing act is especially daunting for Deutsche Bank because higher rates could crimp borrowing and spur defaults among its retail and corporate clients, while rising default rates on existing loans can strain the bank's capital reserves. Furthermore, the specter of major energy shortages in parts of Europe, ongoing geopolitical tensions, and potential trade tariffs from major partners like the U.S. mean that Deutsche Bank could face an onslaught of simultaneous risks. Adding to the bank's woes is the erosion of trust from global investors, some of whom recall that Deutsche Bank's share price plummeted to record lows a few years back amid swirling questions about its stability. Despite attempts at reassurance, the bank continues to pay penalties and legal settlements tied to past misconduct, eroding both its finances and its credibility. This environment makes it increasingly difficult for Deutsche Bank to attract the capital it might need in the event of a crisis. Should liquidity conditions tighten, the bank might be forced to offload assets at fire sale prices, unleashing a ripple effect throughout Europe's interconnected financial system. And don't forget Deutsche Bank's role as a cornerstone lender to Germany's industrial sector. If economic conditions in Germany weaken further, major corporations could default on loans, real estate developers could falter, and consumer confidence could plummet, all of which would reverberate back onto Deutsche's books. What scares analysts the most is that if Deutsche Bank goes down, it won't just be a localized event. The contagion effect could be catastrophic, potentially dragging down other major European financial institutions in the blink of an eye. This interconnectedness is precisely why global markets keep one nervous eye on Deutsche Bank, fearing that 2025 might finally be the year the cracks become gaping chasms. Number 1. J.P. Morgan Chase. Many of you might be surprised to see JP Morgan Chase sitting at the top of this list, but the reality is that the biggest bank in the United States could be staring down the barrel of a monumental collapse come 2025. We're talking about an institution that boasts trillions in assets, sprawling global reach, and a derivatives book so large it dwarfs many of its competitors. Yet, as we know from financial history, size doesn't guarantee immunity. Sometimes it simply magnifies the impact when things go wrong. Ironically, JP Morgan Chase has been a key beneficiary of crises in the past, snapping up failing institutions and consolidating assets under its umbrella. But if a worldwide liquidity crunch were to intensify, especially one triggered by simultaneous downturns in the US, Europe, and Asia, JP Morgan's colossal derivative exposures and far-reaching commitments could implode faster than anyone expects. To understand the risks, consider that the bank has been one of the most aggressive in corporate lending, mergers, and acquisitions during a time of cheap money and strong market momentum. A lot of those deals were priced with the assumption that growth would continue indefinitely and that interest rates would stay manageable. Flash forward to now. Interest rates are climbing, companies are wrestling with debt obligations, and consumer demand is teetering on the edge of a potential downturn. Analysts warn that if defaults start piling up, JP Morgan could be forced to absorb billions in losses across its loan books and trading accounts. Add in the possibility of a massive bond sell-off if investors panic, and you're looking at a perfect storm. Moreover, JP Morgan's fortress balance sheet, though frequently lauded, could crack under extreme conditions if depositors begin to withdraw en masse in a crisis of confidence. History shows that even well-capitalized banks aren't immune to a full-scale run if public sentiment shifts and institutional clients start moving funds to perceived safer havens. The bank's investment banking arm could also feel the heat as deal-making grinds to a halt, forcing JP Morgan to rely more heavily on net interest income, precisely at a time when rising defaults might eat away at profitability. Let's not forget the regulatory environment could change overnight, especially if lawmakers sense a major meltdown is brewing. Stricter capital requirements and emergency stress tests might force JP Morgan to shed riskier assets at fire sale prices, which could trigger the same domino effect we saw back in 2008. When the biggest player in the room starts selling off assets, prices crash, further eroding balance sheets across the sector. JP Morgan might look impenetrable right now, but it's exactly that kind of hubris the markets love to punish. If 2025 delivers the global stagflationary shock many fear, keep a close eye on JP Morgan because its sheer size could make it the most significant domino of them all. If you're still keeping your money in one of these banks, ask yourself this. Do you really trust them to protect your wealth when the system starts crumbling? Because when these collapses hit, there won't be a warning. Just frozen accounts, emergency bailouts, for the elites, not you, and an all-out scramble for liquidity. Now is the time to be proactive. Move your money, diversify your assets, and don't wait for a mainstream media headline to confirm what we already know is coming. If you found this information valuable, hit that like button, subscribe for more hard-hitting financial truth, and share this video with someone who still thinks their bank is too big to fail. And remember, the game is rigged, but you don't have to be a victim. Stay informed, stay prepared, and I'll see you in the next one.